I realized I never introduced myself. I just make an assumption you've all seen me for the last 4 years doing these webinars, but I'm Jessica Boycourt. I'm a director with KSM's Technical and Accounting Advisory Services Group, which is part of our assurance department, and I'm going to lead us through today. We have quite a bit of information today and some stuff a little more, I would say, fun, spicy, not just technical accounting stuff today. And there's a whole slew of us presenting, so we will go through each one individually at the end as well. The presentations that we're going to cover today are economic updates and trends specifically related to economic development, ASUs effective for the 2025 year end, variable consideration under revenue recognition standards for GAAP. We'll do a general standards update, how to apply AI for success in audit, accounting, finance roles, subsequent events, and then GAAP accounting for warrants and stock appreciation rights. We have to do something overly technical just to keep everyone on their toes. So again, the CPE check-in information is up there on the screen. We'll remind you to check out before you leave, but that's kind of, I like this visual. If you're doing it on a phone, you can see what the app looks like and make sure that you're checked in and where to submit the code words as well. I talked about the topics already, and we will have a short break in the middle. That way you can grab a snack or grab some extra coffee to get you through the second half, since it's a little bit longer event today. We like to practice with code word number one before we start getting into the topics, just to make sure everybody's ironed out and set on their CPE requirements. We'll let that sit there for a minute first. Code word number 471. Again, get logged in via the app or the QR code. If you can't get logged in, take a pen, note down these code words as we go, and we can, you are able to submit them all at the end. So code word one, write that down, 471. Now we're going to get into the real fun meat of today. We're going to start with Amy McDonald. She's going to walk us through economic updates and trends in economic development. Amy is a vice president with KSM Location Advisors, and in her position, she provides a variety of tax compliance and consulting services in the areas of multi-state sales and income tax, property tax, business incentives, and other state taxes. We are very excited to have Amy here with us today to give us a little bit of an update on the trends in economic development. So I'm going to turn it over to Amy.
Hey. Hello, everyone. As Jessica said, my name is Amy McDonald. KSM Location Advisors is an advisory group within KSM. And our main service is we negotiate state and local tax credits and incentives for clients. So I'm just going to talk today about economic development. What is economic development? What are components of projects that we work on that qualify for incentives? And then just some trends in economic development that we have been seeing. So to start, I'll just kind of take a step back. What is economic development? Economic development is basically how an area, community, a state improves the social well-being of its people and its economic and political being. So it involves a lot of different components. Employment opportunities for residents. It involves the improvement of infrastructure in the area, which inherently then improves the tax base of the area to be able to contribute that to residents. And just overall quality of life and, quality of opportunity for people who are in the community. So economic development components exist, or offices exist within each state, region, local jurisdiction, and then also nationally. So within each state, it may, the Economic Development Office may sit in, let's say, a Department of Commerce, or it may be a public-private partnership like Indiana has with the Indiana Economic Development Corp. And And then regions can also have their own groups that they form. So for example, the Kansas City region has a regional group since it deals maybe in multiple states, or Central Indiana has a regional group called CERTA, which is various counties that are in Central Indiana. And then local jurisdictions, redevelopment commissions are groups that deal with projects that are creating jobs, creating tax base for their community. Or they may have an economic development director. And then on a national scale, there are plenty of programs that get created to spur development in various areas of the country. So maybe lesser known, though, is universities, for example, are very involved in economic development. Technical colleges are very integral to training certain types of employees that companies are looking for when they are entering a market. Utility companies also have groups that will contribute maybe a reduction of somebody's power bill maybe every month if a new company is coming into one of their service areas and maybe using a lot of power, a certain amount of power. So utility companies also have incentives that they can contribute to these projects. And then also industry associations are very involved in attracting companies, connecting companies in communities. So, like in North Carolina, for the life sciences industry, there's the Biotechnology Center. Or Indiana has Connexus, which is our manufacturing association, and very involved in all matters, related to the manufacturing industry. So key phrases you might hear or are familiar with that relate to those of us in economic development, this space. If you hear workforce development, that is something that is talked about a lot. If you hear the term upskilling, that is something that we talk about a lot, the area of training employees for companies who need certain skills. Site readiness is a term that you may hear also, where communities maybe have programs to get sites ready with utilities or with existing product so that it's easier for a new company to move into the community. Credits and incentives, those are the programs that we negotiate for our clients at the state and local level that give companies funding or ongoing, reductions of tax and whatnot if they are doing something in a state or a community that qualifies for those programs. Quality of place, quality of life, quality of opportunity, all of these phrases relate to economic development. So incentives programs. So these are the tools that communities, states have at their disposal for companies who are wanting to do certain things or grow in certain areas that they can contribute and try to entice people. So they can come in the form of cash grants, tax credits, forgivable loans. Maybe it's an expense reimbursement. Maybe the incentive is an in-kind service. So, a technical college may partner with a company to train their employees at no cost to the company. So that would be an example of that. Or maybe it's donated property that a city owns that they can donate to a company to entice them to locate there, or like a sales tax exemption. So these are all forms that incentives can take, and they're different all across the country. So what are key components of what we call a project that we discuss with companies and also state and local governments that would be attractive for incentives? So there's really three buckets that I tell our clients that are important when talking to state and local communities about these incentives. The first is job and wage creation. So new jobs, new wages, various areas. I mean, the thresholds for how many jobs you need to be creating to qualify The wages that you're paying your new employees are very different across the country. For example, Georgia, you have to be at least paying above the lowest county's average wage to qualify. Another example would be Michigan has a 50 new job threshold to qualify to apply for their incentives. So it's very different across the country. Ohio, you have to be creating at least 10 jobs to qualify for a lot of their programs. So the second bucket is capital investment. So we ask a lot of questions about, are you building a new building and quantifying what amount you're going to be spending on that? Are you going to be adding, real and personal property both? Are you going to be adding new equipment to your manufacturing facility? How much are you going to be spending on that? Also, are you looking at a new state to open a new office? Are you moving, even in a lease situation? Are you moving? Are you taking down more space? And if you are, maybe you're adding jobs. So maybe the job creation programs would be available to you. And then also investment in infrastructure. So are you going to have to improve, let's say, a road by your facility? And that can also qualify for some incentives. The third bucket is workforce development or training. So this is a very important topic. While I would categorize it as kind of the third bucket, it's a very important topic because economic development is all about community development. And so training, upskilling employees, what skills are you providing? Are you providing leadership training? Are you involved in apprenticeship programs? Those are important questions that a lot of states and communities like to hear about. How are you taking care of your employees that you currently have? And how are you going to train new ones that come in? So another component to projects that we work on with incentives is this concept of target industries. So target industries, a lot of states have posted even what their target industries they are going for to attract. So they can be as broad as, manufacturing or distribution or something like that. But they can also sometimes be a lot more specific than that. So as opposed to, let's say, just manufacturing, a state may say, our target industry is actually chemical production. So that's way more specific. Or aerospace, or let's say not just information technology, but agriculture, ag tech, as we say, technology and agriculture. So those are just some specific examples. And these states will focus on these industries because they have a vision for what they want their state to be and what types of companies they'd like to see grow there. So now I'm going to just quickly touch on some national overall trends that we see in economic development lately. This is probably not a surprise to a lot of you, but increase in foreign investment is one of the trends that we are seeing right now. The conversation about reshoring, bringing your supply chain closer to you, so that there aren't as many, barriers to your supply chain. So an example of that, some of you may have seen this in the news, but Stellantis recently announced a very large investment to bring their manufacturing back domestically over the next 4 years in Illinois, Indiana, and Michigan, and Ohio. And so that is definitely a trend that we are seeing. Another trend that we have been seeing lately is just projects that are on pause. So, let's say maybe a couple years ago or even last year, we're working on a company with a company on a project to build a new manufacturing facility. And all of a sudden, a lot of people took a pause because tariffs were definitely a big topic. People were all of a sudden reanalyzing, how are these going to affect my revenue stream? Should we even be doing this project right now? Should we even be looking at a new office or facility? High interest rates, that is another reason why we have seen projects take a pause or just get drawn out way longer than normal. And then tighter capital and just access to even things like building materials, transformers, things like that. A third trend that we are seeing is just more and more discussion about utility capacity as well. So, it's not necessarily a new conversation, the stress on maybe our power grid. I'm sure a lot of people have heard conversation about the grid and just, do we have enough power and the strain of it? But also with the topic of data centers, more data centers, they use an incredible amount of water. So communities are always trying to, when projects are coming into their community, when new builds, new companies, they are thinking about their utility capacity, and it's getting talked about a lot. For example, Illinois, in their most recent legislative session, just expanded one of their tax credits to be able to apply to transformer manufacturers and nuclear energy technology manufacturers. So try to expand the capacity of energy. Indiana did the same thing in their last legislative session. They created a new incentive for manufacturers, and this is a little bit of a mouthful, but of small modular nuclear reactors. And we actually just had a press release recently about a company who is going to be manufacturing these, which, that this program applies to. So other trends we're seeing, so labor availability. This is always a topic of conversation with our companies, but it is also a topic of conversation with states and communities. How are we going to retain our workforce? How are we going to close the skills gap, as we say, with potentially people retiring and new people kind of coming up that don't have the same skills? So here's a real live example of that. But Ohio recently announced a new relocation incentive that will give companies cash for each new employee that they bring, full-time employee, in STEM or a similar technical profession that relocates from outside of Ohio into the state and becomes a resident. So that's just one way that we have seen people try to address this conversation. And then another trend is a more tightened incentives compliance approach from states and communities. So when I say compliance, all incentives that we negotiate require some sort of ongoing compliance over time, basically to tell the community or the state or the region that you are meeting the goals that you set for your new build, for your move, something like that, in return, that they give you then an incentive. So, I'm sure there's a whole host of things that this could be attributed to, but a couple that come to mind for me is just, number one, incentives definitely were put on the forefront of the news, by mega projects. And so for example, Amazon and their HQ2, the bid, the RFP that they put out to multiple states, where are we going to locate our HQ2? And then all of a sudden, incentives were being talked about a lot in the news, which adds scrutiny to these programs and how states and communities are using public dollars. And then also Indiana, in our last legislative session, SEA 1 was passed, and that was a very property tax focused bill that ultimately will, decrease the amount of property tax revenue that communities can receive. So with that comes communities reanalyzing what their projected revenue is going to be in the future. And that could make them less likely to be able to be flexible with companies when maybe they don't quite meet their goals when they're doing their annual compliance year over year. So, and then just in general, with incentives, speed and the types of incentives that communities and states are willing to give do influence final site selection for our companies. For example, North Carolina with the Research Triangle Park in Boston, they win a lot in the life sciences industry because they have a lot of availability with wet lab space. Or, you know, if communities have site readiness programs where they're getting sites ready with utilities, with even spec product, you know, for companies to just move on into, that it definitely influences people's final decision on where they locate. So, okay, so how does, you know, accounting and auditing fit into the world of economic development? So this is just kind of a life cycle, a high level life cycle of when you get an incentive. What happens? You receive this award, you execute your project, you know, the company builds their building, but then CPAs are very important and integral in the process because accounting and auditing teams need to verify that the company has done what they said they were going to do. And then report that out to the various stakeholders, such as the town or the county or the state. In order to make sure the company receives their benefit. And then, you know, just other consideration or the other considerations related to economic development. You know, it is important, like thinking about, for example, reshoring. Reshoring impacts accounting. So all of a sudden you were thinking about new tax exposures, new depreciation patterns, new changes in cost structures, things like that. And also, a lot of incentives, you know, on the audit side, a lot of incentives need to have an agreed upon procedures done. Some of these programs require that. That is something that the audit team at KSM does for some of our clients when they need one of these things done. So just to confirm that they have created the jobs and made the investment. So I guess moral of the story is if you have incentives, make sure your accounting team and your auditors know. And if anybody out there is, you know, interested in learning more about incentives, definitely feel free to get a hold of me or somebody, your KSM representative. So thank you so much.
All right, thank you, Amy. As you can see, we have Amy's information here on the screen. You can reach out to her if you have any questions. I think it's always great to kind of see where things are at and hear how that connects to the world of accounting and auditing with all the other services that KSM is providing. So we're going to transition to our next topic, a little bit more technical, but we're going to have Sevi Duncan share some updates on ASU's effective in the 2025 year ends. In the meantime, we'll have code word number 2. So those of you that were asking about getting logged in for CPE, the QR codes again on the screen, code word number 2 is 984. We'll give you a second to jot that down while we get transitioned over to Sevi. So Sevi is newer to KSM, but he is a director in KSM's Audit and Assurance Services group, where he leverages his extensive expertise to work with clients across various industries, ensuring accurate financial reporting, minimizing risk, and maximizing operational efficiencies. He also guides clients through the implementation of new accounting standards and helps to strengthen their internal controls. He's going to cover, as I mentioned, accounting standard updates that are effective for December 31, 2025 year end. So the upcoming standards that are effective. And we are very lucky to have Sevi with us today.
Thanks, Jessica. So as mentioned, I'm Sevi Duncan. I'm a director here at KSM in the audit practice. We're going to cover ASUs effective December 31st, 2025. Here's our objective slide. First and foremost, just to identify which ASUs are effective for December 31st, 2025 year ends. And then secondarily, to describe the primary impacts of those ASUs on private company accounting, as well as any related disclosure requirements. So this slide just gives a quick summary of key accounting standard updates that impact 2025 year ends. You'll note that there are 5 main topics listed, but the 2 most significant are digital assets and joint ventures. Both introduce entirely new accounting frameworks under the new standards. Reference rate reform is more of a review or as temporary relief phase ends at the close of 2025. The other updates listed at the bottom of the slide are narrow in scope or industry specific, so we're not going to cover those in detail during this presentation. So this slide covers the digital assets ASU update 2023-08. This is a major change as we move away from the impairment only model under ASC 350. Crypto assets are now going to be measured at fair value every reporting period, and changes are going to be recorded through net income. The idea behind this change is really to bring transparency and reflect real-time changes in both economic as well as market conditions. The new standard applies to fungible blockchain-based assets not issued by the reporting entity effective after December 15th, 2024, with early adoption being permitted. Some of the key disclosure requirements related to this change include the types and quantities of crypto held, amounts presented at fair value and cost basis, and a roll forward of activity showing gains, losses, and liquidity details, as well as noting any sale or use restrictions on the crypto. This slide covers joint ventures, another one of the biggies for this year, ASU 2023-05. So previously, there was no clear GAAP guidance for forming a joint venture. Most companies used a carryover basis, which ultimately led to inconsistent results in application and financial reporting. The new guidance under ASC 805-60 now requires the joint venture to record identifiable assets and liabilities at fair value upon formation. It's treated similarly to a business combination, which allows for the recognition of goodwill when appropriate. Ultimately, this is going to improve consistency as well as comparability across firms and industries. The standard is effective for fiscal year ends after January 1st, 2025, so applied prospectively for newly formed joint ventures. Early adoption is permitted, provided the information was sufficiently available. Some of the key disclosure requirements here include the nature and purpose of the joint venture, the valuation methods used, and quantitative and qualitative details around the assets, liabilities, as well as any goodwill that was recognized. So this slide is the refresher on reference rate reform. This update provides optional relief for contract modifications tied to the LIBOR transition. It allows entities to continue hedge accounting without triggering a de-designation event or unnecessary income volatility. It applies to contract and hedge modifications made due to reference rate changes, which ultimately is going to help smooth the transition to new rates like SOFR. The relief expires December 31st, 2025. So that's the key date here. All affected contracts should be fully transitioned by this year's end. Some of the key disclosure requirements include modified contract amounts, practical expedients applied, the status of transition to any of the replacement rates, as well as any remaining exposure to LIBOR. One of the biggest 2025 updates is the rollout of the new audit quality management standards, SQMS 1 and 2, as well as SAS 146. These shift from a compliance-based approach really to more of a risk-based system that better connects firm and engagement level quality. They introduce greater accountability, some structured monitoring, and some clear documentation expectations within the firm. They are effective for fiscal year ends after December 15th, 2025. And so on this next slide, we'll take a look at how the new quality standards ultimately differ from the old QC model. So under the old QC section 10, quality control focused on policies and compliance. Ultimately, it was a bit more reactive, less connected to engagement level performance. The new system of quality management replaces that with a risk-based framework around 8 key components. SQMS 2 adds annual monitoring and evaluation, and SAS 146 aligns engagement level supervision with firm level quality. As mentioned, these are effective for fiscal years ending after December 15th, 2025, with early adoption permitted. Some of the key takeaways here include enhanced internal documentation requirements around objectives, risks, and monitoring results. The new standard establishes a clear leadership accountability hierarchy for quality management. And ultimately, from a reporting perspective, while there's no client reporting impact to this change, internal documentation is going to be critical for consistent application, compliance, and ultimately peer review. I know that was short and sweet, but we tried to distill these ASUs down to 3 major components. Ultimately, what the old standard was, what the new standard is going to be, and how the primary effects of that, as well as any related disclosure requirements. So thank you for your time, and certainly feel free to reach out to Jessica or myself if you have any questions or concerns related to the ASUs effective as of 12/31/2025.
Perfect. Thank you, Sevi. And I think all of us can appreciate that that was very short, given that in the last 5-6 years, it feels like everything has changed drastically every year. So there is no new rev rec, there's no new lease standards, there's not CECL. So as much as, you know, as short and sweet, it's kind of nice to have a little bit of a break externally, at least for the ASUs. So I do appreciate you running through all of those today. I also just wanted to point out, while we have this code word number 3 up on the screen, code word 3 is 284. The last piece that Sevi mentioned on the quality management standards, that's applicable to the CPA firms. So I know there's a mix on the webinar of both practitioners and you know, the clients. So it's more of just an understanding that over time, the industry, you know, the AICPA and the accounting industry has really evolved as well on the backside of what is required for us as the CPA firms that are, you know, performing the audit and attestation services. So that's more of a kind of FYI to the clients and organizations on the call, that we're not just presenting to you all the updates that we have to do for GAAP compliance, but there are changes being made that are kind of, you know, progressive and risk-based internally as well. So wanted to share that out, but know that, you know, it won't change anything in terms of how you interact with KSM as your service provider, but it's just additional kind of internal control policies for us to follow. All right, so next up, we can't do the A&A update. I think on all of I've been at KSM for 16 years, and I feel like we've probably presented on revenue recognition all 16 of those years. And so we're just gonna do it again, because why stop now? But we're going to be focusing on variable consideration specifically, because even though the revenue recognition under topic 606 is not new, it's considerably changed what we were all used to doing. No pun intended, since I just said considerably changed, but with one of the areas that we continue to see clients and even internally struggle with this concept of variable consideration. So wanted to focus on that today. Brian Fender is going to help us cover this topic today. Brian is a director in KSM's Audit and Assurance Services group, where he helps clients minimize risk, ensure accurate and complete financial reporting, and maintain compliance with all regulations and rules. He also advises clients on proper internal controls, policies, and procedures to help them operate more efficiently. He works across a multitude of industries, which kind of is good for this presentation in particular, because he was able to provide some kind of practical examples that come up across the various industries that we serve and that he serves. So I'm going to turn it over to Brian to help cover revenue recognition and variable consideration.
Thank you, Jessica. As you mentioned, my focus today will be revisiting the revenue recognition standard and specifically the nuances around variable consideration. I don't know if this qualifies as one of the fun and spicy topics you mentioned earlier, but it is a really important one. You know, again, luckily we don't have ASUs coming up as significant as this one has been, but this is one that sticks around and is just one of the most critical ones. So happy to cover this today. So why is this important? Why revisit this topic? So this standard just continues to challenge many companies, even 6 years after it became effective for privately held companies. It's a different model than many of us grew up with and started our careers learning. And since the standard became effective, we've just seen a rapidly changing business environment. What was assessed when the standard was adopted years back could have easily become outdated, either based on changes in the nature of the contracts you have with your customers or how significant and material certain elements of those contracts have become since the adoption date. Additionally, revenue recognition is always going to be at the forefront of what lenders, investors, and ultimately us as well will be concerned with. So this is perhaps one of the most critical areas for any user of a financial statement. Variable consideration in particular, which we'll cover today in detail, remains one of the most misunderstood areas of this standard. And misapplication there can really result in things like revenue reversals, inconsistent estimates, and correction of errors, unfortunately. So getting this right is just critical for both financial reporting accuracy, but also just general business forecasting as well. So today's objectives here, we're going to do a quick refresher on the revenue standard ASC 606's 5-step model. We're going to explore step 3 in more detail, determining the transaction price. That's where variable consideration fits. And then finally, we're going to look at some real world examples as well. And just along the way, we'll cover some common pitfalls to watch out for when you're looking in this area. So let's just start with a recap here of the overall revenue recognition principles. Understanding these, taking a step back, is just really important as we get more detailed into variable consideration. So this is a refresher, but the principle-based standard and the core of it is an entity shall recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. I need a breath after that. It's a lot, but the good thing is the guidance gives us this 5-step model to follow. So the first step here is just identifying what contract or maybe even contracts we have with a customer. That's step 1. Step 2 is identifying each performance obligation in the contract. So what do we need to do for our customers as part of fulfilling that contract with them? Step 3 is determining what the transaction price is. Then after we've determined that transaction price, we would allocate it to the various performance obligations we've identified. So potentially there's more than one thing we have to do. Maybe we need to allocate that transaction price to those different things. And then finally, once we've done all of this, we can finally get to recognize revenue when or as those performance obligations are satisfied. So this is very foundational, but we wanted to recap it before we dive in. And I'll note here, you'll see highlighted in orange is step 3, determine the transaction price. That's where we'll be focused today. That's where variable consideration falls. So step 3 here just defines the transaction price as an amount the entity expects to be entitled to. So this can either be fixed or variable. You know, if it's fixed, it's pretty straightforward. It's something that's known, measurable up front. Maybe it's listed out, straightforward. Variable considerations really just arises from variability, such as, you know, some examples would be rebates, price concessions, or something that's outcome based. I do want to emphasize here, when we're talking about variable consideration, we're not talking about whether the cash varies or not. We're talking about whether the entitlement to that varies. So don't confuse collectability or credit risk with transaction price variability, which is what we're talking about, which is variable consideration. Variable consideration is when the amount of consideration we expect to be entitled to might move. That falls under step 3 of ASC 606. By contrast, collectability asks whether a contract exists at all and the customer has the ability and intent to pay. That we would look at in step 1 of ASC 606, looking at the contract, or subsequent to revenue recognition, we would think about that credit risk, that collectability, separate from the revenue guidance later on. So let's take a step at what variable consideration can look like. So on this slide here, you'll see we kind of have the definition here. Again, it's stuff that can change based on future events, performance, timing, volume, usage. I've listed some specific examples, the codification list here. So really common ones would be volume rebates and tiered pricing, performance-based bonuses or penalties, refund rights and returns, any usage or sales-based royalties, and then potentially price concessions as well. I do want to emphasize the final bullet point here, price concessions. Entities must consider all forms of variability, even if it's not something that's explicitly mentioned in the contract. So this could be implicit price concessions or discounts that we maybe don't have written in, but maybe we do those in practice. That could also represent variable consideration, which could defer revenue that we also need to think about. So here's kind of some examples out of the codification. On the next slide here, let's look at some real world examples. So you'll see various industries listed here. Manufacturing, distribution, technology, transportation, dealerships, real estate. These are just a few listed here. As you can see, variable consideration is not a niche concept. It's in nearly every industry where price depends on performance or volume. So we'll cover some real examples later on. I'll focus on manufacturing, distribution, and some technology, but here are some examples listed on here for these. Before we get into some actual examples though, let's look at the methods we can use to estimate variable consideration. So 2 methods here. Following the guidance, entities can estimate variable amounts using one of these 2 approaches, either the expected value method or the most likely amount method. And when choosing your approach, you just want to keep in mind that you should be selecting the method that best predicts the amount you'll ultimately be entitled to. The expected value method might be best when there's multiple possible outcomes with measurable probabilities. Perhaps you're looking at a portfolio of similar contracts or high volume arrangements such as rebates, somewhere where there's data patterns that exist. Here you would maybe use like a probability weighted average of possible outcomes to estimate the variable consideration. On the flip side here, the most likely amount method would be best when there's a single most probable amount. And this really focuses on the likeliest outcome rather than a range of possible outcomes. So this method best suits binary outcomes. An example might be an all or nothing clause in a contract for an implementation bonus or something like that. And I'll just point out that consistency in application is key here. So once you select one of these methods for one of your contracts, you should really be applying this consistently to similar contracts with similar characteristics as well. So on the next slide here, let's cover another core concept. And that core concept is that when you're estimating variable consideration, you should only include variable consideration in your transaction price if it is probable that a significant revenue reversal will not occur. So this is a really core step here for any contract that helps us prevent premature revenue recognition. And I just want to note here that probable under US GAAP is stricter than more likely than not. We're not talking about greater than 50%, flip a coin. Probable means likely to occur. So there's no defined threshold for this. In practice, people typically fall somewhere around 75%, but there's a lot of judgment here. I'll just say that simply put, if there's a reasonable chance that you're going to have to give some of that revenue back, don't book it yet. Be conservative. So this constraint here is probably the most judgmental part of step 3 for the revenue recognition steps. There are some key evaluation factors the guidance points to here that we've listed out. Really it's things that you should look at when you're evaluating whether we have this constraint or not. So anything that's outside of your control, we'd want to look at. The longer it takes for the uncertainty to resolve, the more uncertainty is probably there. So the length of time. Do we have historical experience in this area, accuracy that we can fall on for similar contracts? Do we have the ability to influence this outcome or not? And then how many outcomes could there be? All of these are things that we would look at. So when you're thinking about these, having strong internal documentation on why a reversal is not probable, if that's the conclusion you reached, is really important. These are estimates that should be updated along the way. So having these estimates determined up front, but then continually revisiting them is important. On the next slide, I want to take a look at the overall process for applying the constraint. So first, we want to estimate the variable component. We already covered that with those 2 methods. Once we've done that, we would then apply that constraint test, and that's what we just looked at as well. We'd ask, is a reversal probable? If we've reached the conclusion that a reversal is not probable, then we would only include the portion that passes that test in the transaction price in step 3 of the guidance. So on the next slide, I really want to focus on that constraint test because there's just a ton of judgment that goes into that. So let's look at some examples or things we might look at on the next slide. So these factors would indicate whether a significant reversal is probable. They kind of coincide with what we've already covered, but I just want to emphasize these again. Factors outside of our control, maybe what our customers do. Are we at the mercy of our customers? Limited experience in the area, long resolution periods. If our contracts are really susceptible to regulatory or external events, and then just our ability or our inability to influence the outcome should be looked at here. And I just say a key theme is that all of these factors represent more estimation uncertainty. And if any of these are present, there's way more significant judgment involved. And then really revenue recognition should be conservative if we have a lot of these factors present. So now we've covered some of the core concepts here. Let's look at some real life examples. So this first example we have is a rebate program for a manufacturing company. This is something that I see very often in practice. In this example, we have a company where their customers are going to earn a 5% rebate on total annual purchases once they meet the volume of 500,000. So once they hit that, they're getting a 5% rebate on everything they've purchased and anything on an ongoing basis. So the potential rebate there would be considered variable consideration. We have probably multiple possible outcomes here. So we might look at the expected value method. In this example, let's just pretend that we expect total annual sales for this customer to be 600,000. So they're going to pass that threshold. So we're going to expect the 5% rebate here. So 30,000. So our transaction price is only 570,000. We would ask, is a significant revenue reversal probable here? No, because they're either going to hit that or not. And if we're accounting for it in that way, we're not going to have a reversal. I think the key mistake here, though, would be waiting until year end to recognize the rebate portion. If we expect them to receive this rebate, we should be accounting for that early on. So let's just say for this customer, their initial order is only 200,000, and we've shipped and delivered under FOB terms, destination terms, 200,000. Well, we need to account for that rebate up front. In this case, we would recognize only 190,000 of revenue here because we expect to provide that 5% rebate or $10,000. And then we would book our receivable for 200,000, but only revenue of 190,000 which is net of that discount that we would report as a liability. And I'll just point out, this is a really simple example here. In practice, I think most manufacturers, distributors are going to have hundreds of similar rebate arrangements with their clients. In that case, they could probably use a portfolio expedient, essentially grouping those contracts together using an expected value approach. So instead of one binary outcome, customer A either meets or doesn't meet this threshold, we would look at that probability distribution across all of our customers and maybe ask, okay, hey, historically, 60% of our customers exceed this target and 40% don't. So we could blend that into a weighted average rebate rate for the portfolio. So 60% of that 5% discount, we're going to come up with 3%. And then we're going to use that 3% as a reduction of all revenue we're recognizing for sales that could qualify for this rebate eventually. So this adds some complexity, but it will help us produce a more accurate and operationally effective estimate when there's a large number of these contracts. On the next slide here, I want to cover another example, a performance bonus for a technology company. This one's a little simpler. So let's say we have a technology company that has a 100K implementation bonus if they go live for their customer by December 31st. So this contract has a 500K fixed amount, but that bonus is variable. Since we have a binary outcome here, we would use the most likely amount method that we discussed earlier. So we would include the bonus in that initial transaction price only when it's probable that no significant revenue reversal will occur. So if we think, okay, like we're going to get this implementation bonus, we really still need to take a step back and ask, is it probable or not that we won't have to reverse this revenue? For this example in particular, we might look at our historical process on similar, historical timelines on similar contracts. And then we'd also just look at, what are our dependencies from the customer, their sign-offs, their ability to get their people involved timely, any scope changes, user setups, for example. We could really be at the mercy of our customer here, and this could really be outside of our control. And based on that, you could have a hard time concluding that it's probable that that significant reversal won't occur. And if that's the case, you would constrain revenue and wait to recognize that until later. So now that we've covered some examples here, let's just take a recap on the whole section of variable consideration. And I've kind of broken this out into 3 key takeaways. I think takeaway number 1 is just to understand the framework in general. Determining the transaction price where variable consideration falls is just one small component of the overall revenue guidance. And I think it's really easy to look at certain elements and confuse yourself of where you're working. You could look at elements you think fall into step 3, but they really fall into step 1. So just knowing where you're working is critical. Understanding how estimation is involved here is critical. And estimating early and applying these consistently is also important. So making sure you're choosing the right method for what you're looking at. Should we use the expected value method for portfolios of similar contracts or high volume arrangements, or maybe we should be using the most likely amount method for binary outcomes? It's just key here to get the right method and do this early to avoid hindsight recognition. We want to figure this out up front and have proper documentation for that estimate up front. And then finally, just constraining and reassessing here. You really only want to include what's probable not to reverse, and you want to revisit these estimates each period. So that wraps up my presentation today, and I hope this was insightful for everybody. My contact information is above, so please don't hesitate to reach out if you have any questions in the chat, or to me directly, or to any member of your KSM service team. Thank you.
All right, thank you, Brian. That was definitely one of the spicy and fun topics I was talking about earlier. We do have one more code word now. So code word number 4 is 813. Again, the login and everything is on the screen there. I think it's great to continue to cover and remind and revise how we think through revenue recognition and kind of those sticky areas. So hopefully that was a good kind of refresher, solidifying how we think through variable consideration. Next up, because we're approaching noon, it's almost been an hour of topics. We are actually going to take a break. We'll take a 10-minute break. Please be back around 12:07, and if you are in the Eastern time zone, so we'll take a 10-minute break, start back up at 12:07 Eastern. Okay, we will restart in about another minute. It is 12:06, so if you can hear my voice, we will get started again at about 12:07. I'm gonna go ahead and switch the screen to the next slide because it does have a code word, but I'll leave that up while we come back from break. Okay, for the official clock on my computer, it is 12:07 p.m. Eastern. I need to erase my drawing here. There we go. We are going to restart the break, of course, with another code word. That code word is 582. So you want to make sure that you've navigated to the Conference IO app and get that code word in. I'll leave this up while I introduce our next presenter. That way, as you settle back in from grabbing a snack, I chose a Nature's Bakery Blueberry Fig Bar. That'll be my pseudo lunch until we're done today. We are going to transition next to Reagan Donahue, and Reagan is going to cover the most recently issued ASUs and the Financial Accounting Standard Board's current projects. So a little bit different from what Sevi covered earlier, and this is ASUs that are not effective yet, but they have been issued by the FASB, so we're going to go over those as well. You'll notice that when she goes through, there's quite a few ASUs that they have expected to be issued in the fourth quarter of 2025. So any time now, none of those have been issued final yet. So we'll keep eyes on those as well. So I'm going to go ahead and introduce Reagan and let us get started with the next topic, the accounting standards update. So Reagan is a manager in KSM's Audit and Assurance Services Group. She works with clients to ensure accurate financial reporting, avoid risk, and maximize efficiencies. She serves clients in a wide range of industries, most notably real estate, construction, and financial services. And so I am happy to welcome Reagan today to discuss our accounting standards update.
Thank you, Jessica. Hi, everyone. I'm happy to be here today to share some accounting standards updates. After this presentation, hopefully you'll have a good overview of the recently issued ASUs, as well as the projects that the FASB has on deck for the upcoming months. So far, as of today, the FASB has officially issued only 2 new accounting standards updates since last quarter. However, they do still expect to issue final ASUs for an additional 6 items before the end of this year. The first ASU that the FASB officially issued this quarter is ASU 2025-06 related to internal use software. The goal of this updated standard is to modernize the accounting for internal use software because the FASB recognized that software is not always developed in a linear manner, which was the underlying theme of the old guidance. Under that old guidance, entities were required to capitalize development costs incurred for internal use software, depending on the nature of the costs and the project stage during which they occur. Now, project stage is the key term here because the project stage is defined in the old guidance assumed that the development was occurring in a linear step-by-step fashion. But under the new guidance, all references to project stages have been removed and entities are required to start capitalizing internal use software costs as soon as management has committed to funding the software project and it's probable that the project will be completed and used to perform the function intended. And this is now called the probable to complete recognition threshold. The management is required to evaluate whether there is significant uncertainty associated with the software's development activities in order to determine whether that probable to complete recognition threshold has been met. This threshold has not been met if there are uncertain functions or features of the software that have not been proven or resolved through coding and testing, or if the significant performance requirements of the software have not been identified or they continue to be substantially revised. This new ASU does also come with some updated disclosure requirements. Essentially, the disclosure for any capitalized internal use software costs will need to follow the disclosure requirements under ASC 360-10 for PP&E, regardless of how those software costs are presented on the face of the financial statements. The ASU also goes further to clarify that intangibles disclosures under ASC 350-30 are not required for capitalized internal use software costs. So in other words, you'll want to use those PP&E disclosure requirements rather than the intangible disclosure requirements. The new ASU is effective for annual reporting periods beginning after December 15th of 2027 for all entities, but early adoption is permitted. There are a few options of how to transition into this new standard when the time comes. It can be applied either prospectively or retrospectively, but the FASB also gives the option of a modified transition approach, which considers the status of the project and whether software costs were capitalized before the date of adoption. The second ASU that the FASB officially issued this quarter is ASU 2025-07. This update addresses two issues: scope refinements for derivatives and scope clarification for share-based non-cash consideration from a customer in a revenue contract. To go a little bit deeper into issue 1, current GAAP already provides certain scope exceptions from topic 815 on derivatives and hedging, but this new ASU will now expand on those to specifically exclude non-exchange traded contracts for which settlement is based on operations or activities specific to one of the parties to that contract. FASB noted in its release that there were concerns that the application of the definition of a derivative was too broad and should not apply to certain contracts. In other words, before this scope expansion was released, there were a lot of different types of contracts that needed to be evaluated and then potentially accounted for as derivatives. But now with this update, FASB is expecting more contracts to be able to be excluded from the scope of topic 815. And that's with the goal to reduce costs and complexity for entities when applying the derivative guidance. So just a quick recap, I said that this scope exception applies to non-exchange contracts with certain variables that are based on operations or activities specific to one of the parties to that contract. The FASB states that this ASU does not apply to contract variables based on a market rate, variables based on the performance of a financial asset or liability of one of the parties to that contract, contracts involving the issuer's own equity, or call or put options on debt instruments. These would all still need to be accounted for using topic 815 guidance. Now, I just went through everything that this ASU does not apply to. So what's actually excluded from the scope of topic 815 under this new scope expansion? Some examples might be underlyings in a contract based on the EBITDA of one of the parties, the occurrence or non-occurrence of an event related to the operations of one of the parties, such as obtaining regulatory authority approval, achieving a product development milestone, achieving a greenhouse gas emissions reduction target, and so on. All of those that I just listed would now not be considered derivative contracts under ASU 2025-07. So issue 1 related to the scope refinement of derivatives is effective for annual reporting periods beginning after December 15th, 2026 for all entities, but early adoption is permitted. The transition method for implementing the new ASU will depend on the date of the contract. So for new contracts that are entered into either on or after the date of adoption, you'll apply that ASU prospectively. But for contracts that already exist at the beginning of the annual reporting period, the standard will need to be applied on a modified retrospective basis through a cumulative effect adjustment to the opening balance of retained earnings. And then there will be certain disclosures required based on the transition method that you use. The second issue that ASU 2025-07 addresses is related to share-based non-cash consideration received from a customer. Now, share-based non-cash consideration would be things like shares of stocks, share options, warrants, or other equity instruments that an entity might receive from a customer in the transfer of goods and services. The FASB's received feedback that there was a lack of clarity about which guidance should be applied to recognize these types of items. So, for example, if an entity receives share-based non-cash consideration from a customer that's contingent on the satisfaction of a performance obligation, would they recognize that contract at inception as a derivative asset under topic 815, or maybe an equity security under topic 321? Or would they wait to recognize it until the entity satisfies all of its performance obligations under topic 606? The old guidance wasn't very clear on this. But under this new ASU, the answer would be to apply topic 606 and wait to recognize that share-based non-cash consideration until the entity has satisfied all of its performance obligations. The other topics that I mentioned, like topic 815 on derivatives or topic 321 on equity securities, would not apply until the entity's right to receive the share-based non-cash consideration is unconditional under topic 606. Issue 2, related to share-based non-cash consideration, is effective for annual reporting periods beginning after December 15th of 2026 for all entities, but early adoption is permitted. Similar to issue 1, the transition method for implementing issue 2 will depend on the date of the contract. For new contracts that are entered into either on or after the date of adoption, you'll apply that ASU prospectively. But for contracts that already exist at the beginning of the annual reporting period, the standard will need to be applied on a modified retrospective basis through that cumulative adjustment to the opening balance of retained earnings. And we do have a code word number 6. So I will pause to give you all a minute to fill that in. So those were the 2 ASUs that the FASB has officially issued as of today. They do have some additional ASUs that they expect to finalize still before the end of this year, as well as some ongoing projects. And here's that list of the current projects that the FASB is working on. The first 6 are the ASUs that are expected to be final this year. And then there's one ASU expected to be finalized in early 2026 related to accounting for debt exchanges. And then there's 3 projects that are still currently ongoing. I'll just quickly go through the ASUs that are expected to be finalized before the end of this year. That way you just have a quick overview. The first one being related to interim reporting. The FASB has received feedback stating that the list of disclosures required in interim reporting topic 270 is complex and difficult to navigate. Therefore, the FASB plans to issue an ASU that aims to clarify, organize, and improve the guidance around interim reporting, and it'll also incorporate disclosure requirements modeled after SEC guidance. The next ASU that the FASB is planning to release in Q4 of 2025 is related to environmental credit programs. The FASB's noticed trends that more and more entities are subject to regulatory requirements related to emissions, and entities are voluntarily purchasing environmental credits from third parties. But as it currently stands, GAAP does not provide specific guidance of how to account for these environmental credits. So this new ASU will provide that guidance and clarity on accounting and disclosure requirements. And then these next 2 slides just go into specifics on the recognition and measurement, presentation, and disclosure for environmental credit assets and liabilities that we expect to see under the new ASU. I won't go through all of them for the sake of time, but they are here on the screen and then in the slides for reference. Another ASU coming up is related to accounting for government grants. The FASB recognized that current GAAP does not provide specific authoritative guidance about the recognition, measurement, and presentation of a government grant. So this led many entities to have to refer to the guidance that's provided in the international accounting standards. Therefore, the FASB is proposing a new ASU that aims to incorporate some of that guidance from those international accounting standards into GAAP. This new ASU will apply to a grant related to an asset as well as a grant related to income, And then it'll also provide clarification on when to recognize the government grant. Under this new ASU, there will be two approaches for recognizing a government grant on the balance sheet. It can either be recognized as deferred income, or it can be recognized as part of the cost basis when determining the carrying amount of the asset related to that grant. And this new ASU would be applied either prospectively or retrospectively, depending on when the grant was entered into in relation to the effective date of adoption. The FASB also has an evergreen project, which is an ongoing project that facilitates codification updates. They've already released numerous ASUs under this project, but they do expect to release another ASU in Q4 of 2025 under the project that addresses 34 issues on a number of different topics. I'm not going to go into all 34 items addressed because most of these updates are fairly minor and they're not intended to result in significant changes for most entities. Another ASU that the FASB plans to issue is related to accounting for credit losses for purchased financial assets. This ASU will expand the scope of purchased financial assets to now include loan receivables while still excluding credit card receivables. But the loan receivables will follow a proposed seasoning criteria to determine whether they qualify as a PFA. And then on the screen, you'll see that criteria that the FASB is using for determining whether a loan is considered seasoned or not. If the loan receivable is determined to be seasoned, the ASU lays out how to account for it. One thing that FASB noted is that the ASU will not result in any changes to the disclosure requirements that are already in topic 326 on credit losses. And then here on the screen, you'll see the rest of the main provisions that the ASU has. The last ASU that the FASB expects to issue before the end of the year is related to improvements around hedge accounting. There are 5 specific issues that this ASU will address, which are listed here in the slide. And the slide also goes into detail regarding the specific improvements that will be made to each issue. And finally, one last big ongoing project for the FASB is the 2025 Agenda Consultation, which is essentially a strategic plan for the next 5 to 10 years to designate different topics that the FASB will focus on. The FASB issued an invitation to comment for the public back in January 2025, with comments then due in June of 2025. And the graph here on the screen shows the feedback that was received from all of those comments. The FASB is likely to focus on the top 5 items here over the next 2 years, but no official decisions have been made just yet. And that's all the updates I have so far for 2025. Appreciate your time.
All right, thank you, Reagan. I know that seemed like a lot in a little bit of time, but do know that at our next event, we will cover once those ASUs are issued final, the ones that Reagan covered fairly quickly in the materials at the end of her presentation. Once those are issued final, we will incorporate those into our next event so that you have more detail, especially those that we expect to be widely applicable, the government grants and some of the CECL items that we know are more widely applicable. Code word number 7 is on the screen. So code word 7429. FASB's been busy, and I know the invitation to comment and that agenda consultation kind of shaping where they're moving next. So we'll also keep you updated on that as we move into our events for next year as well. The next discussion topic that we're going to have on, it's a topic that continues to shape industries across the board, and I'm hopeful that this is why a lot of people joined today, is to hear about AI for client success and how artificial intelligence is reshaping finance, audit, and advisory. We have David Eckel here with us today to discuss how to harness the power of AI to maximize success. David is the managing director of KSM's Information Technology Services Group, and he leads the firm's strategic development and expansion of technology solutions offerings, including IT strategy, virtual CIO, AI analytics, and automation and cloud services. He is very passionate about leveraging emerging technologies to create innovative, scalable solutions that drive long-term success. With extensive experience in IT consulting, David specializes in helping clients align technology with their business goals, driving efficiency, value, and growth. And we are very lucky to have David with us today to speak with us on the topic of AI.
Thank you very much. Hi, everyone. It's great to be part of this year's ANA update. You could consider me a first-time listener and a first-time caller. When people hear AI, they often think of the headlines. You can't go far, whether you wake up in the morning and hop on your device and read the Wall Street Journal or whatever news source, you're going to hear something about AI. It may be data centers being built in your hometown, taking up farmland, or it may be the dangers of AI, but it's definitely something that we read and hear about each and every day. There's a lot of hype about it. Today, I'd like to bring it a little bit closer to home. Today, we're not going to talk about robots, which are cool, or ChatGPT writing financial statements. It's how we as professionals can use AI to deliver stronger insights, better decisions, and more meaningful results for our clients. In the next 10 minutes, I'll share how AI is already reshaping the work we currently do in accounting, audit, and in advisory services, and how we can each start to harness it responsibly. So, as you look at this slide, I chuckle each time that I bring it up because I remember the manual era, and I have lived through each of these different phases and have really a lot of excitement about where we're going. You know, as AI has become that household term, but in practice, it's really just the next evolution in how we use technology to make sense of information. Think about this journey. Automation helped us work faster. Analytics helped us understand trends. And now AI is helping us interpret and then predict. We're already seeing this in familiar tools. I mean, I'm surrounded by 900 plus CPAs here at KSM, and I'm thankful that I have Microsoft Copilot in Excel to help me write formulas, right? Or ChatGPT to summarize memos. So instead of asking, will AI change accounting? I think the better question is, how can it help us do what we already do, but better? At its best, AI isn't replacing expertise, it's amplifying it. At a simple level, AI does four things really, really well. It understands, it generates, it predicts, and then it's able to make recommendations. It recognizes patterns in data that humans might overlook, whether that's transaction trends or cost anomalies or text similarities. AI doesn't think in a human sense. It really surfaces insights. And when we combine that with our professional judgment, the result is faster analysis, better storytelling, and more proactive advice that we can give our clients. The real value isn't in the algorithm. It's how we apply it to real world decisions. You know, AI isn't something that's coming. It's already woven into the systems that we use every day. You know, in the hype of AI, people are thinking that this is a brand new thing. Well, no, AI has been around for a long time. Now we're implementing it and using it in different fashions, and it's become more well known, but it definitely has been around. In accounting, AI today can extract and categorize transactions automatically, eliminating repetitive entry. And that's one of its keys, right? If there's repetitive entry of things or tasks, AI does a great job in helping us accomplish those. In audit, pattern recognition tools flag anomalies in journal entries or in vendor payments for a deeper review. Advisory teams are using predictive models for cash flow or scenario analysis, turning data into strategy. Even reporting is changing. AI can draft management letters or narrative summaries, freeing time for analysis. Just this morning, I asked ChatGPT Enterprise to summarize the emails that I have received from a particular individual. It came back with that summary that would have taken me, 10, 15 minutes to walk through each email, look at it. Well, I had that in about 10 seconds, which freed up my time to do other things. What's important is that these tools aren't replacing us. They're giving us more time to apply our judgment, which is where the real client value lies. Some industry examples, and AI is across all industries. There's a lot of similarities. People find their industries very unique, but when we boil it down, there's a lot of core pieces that are identical and the same. So you could be doing something in one industry as we're talking to clients and take what we learn there and apply it to another. And that holds true for clients internally who are on this journey, where they might find in one department it works great, and the same or similar process could be implemented somewhere else with great success as well. When we talk about healthcare, AI tools analyze payer data to predict reimbursement delays, helping finance teams manage cash flow more proactively. In manufacture, we're seeing AI being used to forecast demand and optimize inventory to help reduce carrying costs. In transportation and logistics, those companies apply AI for route optimization, maintenance schedules, which help cut fuel costs and downtime. And nonprofits today are using AI to summarize donor trends and grant reports and putting those reports into plain language. The common thread connecting all of these is the fact that finance and accounting teams are using AI to anticipate, not just report on what's happening. It moves us from hindsight to foresight. Now, all this points to a much more broader shift. The most valuable professionals, in my opinion, in the next decade will be those who combine human context with machine insight. AI is incredibly powerful at that pattern recognition, but it lacks judgment, ethics, and empathy. And that's our role, and will continue to be that. It helps us see more possibilities faster. You use the analysis as an example. We can go further faster. Should we be doing this or not? We get that information much more quickly. So the new skill set isn't about coding, which is a great thing for me. It's about curiosity. Think Ted Lasso. It's about data literacy and the ability for us to ask better questions. Of course, with these new capabilities come new responsibilities. In accounting and assurance especially, accuracy, privacy, and control matter deeply. That's why we approach AI with a simple framework. It's keep it simple, stupid. We explore, we evaluate, and we embed. And as technology people, we would of course call that EQ. We start exploring small. We use low risk use cases. Maybe it's something like as simple as drafting or analyzing data. I recently took financial information, P&L statements, balance sheets, uploaded in the ChatGPT Enterprise. And from a acquisition perspective, I had it run some analysis based on best practices and KPIs that I wanted to see for that particular industry. And in about 15 minutes, I had that, right? Then I want, or would suggest that you evaluate that. So, okay, that was done in 15 minutes time. The data looks great, but then you've got to dig into it. You've got to check for data quality. You got to look for bias. You need to see if there's any privacy concerns. And then finally, once you've done that, you've started small. You don't want to boil the ocean here. You've started small, then you can actually look and say, all right, I'm going to embed that in my workday. I'm going to take this repeatable process. I'm going to put it into a workflow. Now, the key piece of all of this, and what you'll hear from me and my colleagues here at KSM, is being responsible and ethical, and how we're deploying AI to clients. We're always going to keep that human in the loop, right? You're in the loop, you're centered in it, you're using it to make decisions. It's just not running off on its own. Now, as we come to the end and we talk about some closing thoughts, for me, responsible AI means we keep professional judgment at the center, because trust is definitely our most valuable asset. The takeaway from today, if there's one that I want you to remember, is that AI is not a destination. It's going to continue to evolve, and we are just adding it to our professional toolkit. And we need to continue to do that. Our clients are doing it, our competition is doing it, the marketplace is doing it. We need to embrace it and add that to our tool belt. It should give us leverage, more time, better insight, and the ability to focus on what really matters. And that's helping clients make sound, informed decisions. The firms and professionals who learn to use AI thoughtfully, balancing innovation with integrity, will be the ones that lead the next era of our profession. So as you think about the months ahead, and I know we're all focused on the holidays now that November 1st becomes like the first day of the Christmas season, think about, where could AI potentially make my work a little smarter, maybe a little faster, more insightful, even more fun? That's going to be the best place for you to start. And then wrapping up, I'm going to leave you with a quick question. And that question is, what part of your workday would you love to automate, analyze, or accelerate if you could? That's another great place to start experimenting with AI. It starts with one use case, one process, and one idea at a time. I appreciate you guys listening today. My contact information is there on the screen. Please feel free to reach out at any time. Love to be a sounding board. So thanks again.
Perfect. Thank you, David. I love hearing about that, because as someone who's been around for 16 years, I wasn't in that in the workforce during the 90s when it was all manual. But when I did first start, there was a lot of ticking and tying with blue and black and red pins that now, I mean, I've seen it too kind of be where it's not replacing us, but you know, being able to use AI effectively and efficiently over time. I'll admit that I was a late adopter, and now I use some of the tools every day, and it's definitely helped. So reach out to us. We'll probably, I'll refer you to David if you reach out to me, but love to continue that conversation and make sure that, you know, we're staying on top of the AI curve here. So we have another code word number 8183. Can write that one down. I'll leave it up for a second as we get transitioned over to our next presenter. I'm going to introduce Nathan Oswald, who's going to share some information about subsequent events. So moving back to the purely accounting and auditing world, Nathan is a director out of KSM's Cincinnati office, and he's a member of the firm's Audit and Assurance Services group. He works closely with privately held business owners and management teams to help them achieve their goals. His broad range of experience includes providing audit, review, compilation, and consulting services to both private and publicly held companies. He serves clients across a variety of industries, including manufacturing, distribution, construction services, retail industries, and he also has expertise in auditing employee benefit plans. So I am happy to welcome Nathan here with us today from our Cincinnati office to share some information on subsequent events.
Great, thank you, Jessica. Hello, everyone, and thanks for joining the webinar. As you can see on the slides, we're going to talk about subsequent events today in this portion. So by the end of this session, our goal is that we will have achieved certain learning objectives and that you will be able to understand a few things. One, understanding the definition of subsequent events. Two, distinguishing between type 1 and type 2 subsequent events and how each type affects the financial statements. You also hear type 1 referred to as recognized, type 2 referred to as non-recognized. And ultimately, we want to understand the auditors and management's responsibilities as it relates to subsequent events. So for purposes of this discussion and webinar, we are going to be specifically talking about audit engagements. However, I would say just know that there are also standards required to be followed under other engagements such as reviews and compilations. And throughout this presentation, we will also discuss some real-world examples that will hopefully help aid in better understanding these learning objectives. So let's start by explaining what a subsequent event is, as defined under US GAAP, or generally accepted accounting principles. Under ASC 855, subsequent events are defined as events or transactions that occur after the balance sheet date, but before the financial statements are issued or available to be issued. The standard 855 also clarifies that certain subsequent events guidance may be provided in other topics or other sections, and that guidance should be used instead of the general guidance under ASC 855. So some common examples may be income taxes, earnings per share, gain contingencies. Those areas have specific guidance related to subsequent events, and so that should be referred to and used instead of the general guidance. So the procedures we perform over subsequent events are really nothing new. The concept has been around for a while. And so why have they become significant for companies or important within the accounting profession and financial statements in general? The reason for that is business operations don't just obviously cease at the balance sheet date. A really good example that kind of helps better understand the concept of subsequent events is the COVID-19 pandemic. It really highlighted the importance of subsequent events, particularly for calendar year entities in the United States. So as you all recall, I'm sure, with the pandemic occurring in early 2020, that would have been after a lot of the engagements that were occurring for 2019. So you have an engagement that was being audited or reviewed from January to December of 2019, and then you had COVID hit at the beginning of 2020. And obviously that was a significant event that happened after the calendar year end, and had significant ramifications on companies in general. Some of the ramifications included government programs and incentives, shutdowns, lease modifications, debt terminations, things like that. So you had ultimately a lot of companies not normally impacted by these types of events, suddenly having to consider the effects of these items on their financial statements. Despite this, though, there's often a common misconception that subsequent events are just really a disclosure. And as a result of that, they can become an afterthought during an engagement. And so something to consider is that when we are generally performing our engagement procedures, we are in the subsequent event period. So said another way, if we're auditing a company's January to December 2025 financial information, you're generally performing that audit at the beginning of the next year. It might be January, February, March of 26. And it's during that period that we're out in the field auditing that subsequent events may occur. So because of this, it's a good time to assess how the company or our client's business is changing while we're out in the field doing those procedures, and basically and ultimately determine how those events in early 26 might impact the period under audit of 2025. So what are some common mistakes that we see as we're assessing subsequent events? Some mistakes may be not asking enough questions during that time frame, not asking the right people at the company, and ultimately not obtaining enough evidence to support the subsequent event adjustment or disclosure if it's a type 1, or in the type 2 case, just a disclosure. There's also repercussions for not allocating enough time and resources to procedures over subsequent events. It could lead to a missed disclosure or recognition in the financials, the numbers, could impact going concern discussions and disclosures, and ultimately could result in issuing an incorrect audit report. So definitely something to be mindful of, and that's why we're talking about it. So let's get into the two types of subsequent events. So starting with type 1, what type of events fall under this umbrella? Type 1 events provide additional information about pre-existing conditions that existed on the balance sheet date, including estimates inherent in the process of preparing financial statements. So you may also hear type 1 sub-events described as recognized subsequent events or adjusting subsequent events. To kind of bring that home a little bit, some common examples, or one example would be an event that could give rise to litigation that had taken place before the balance sheet date, and then that litigation is settled after the balance sheet date, but before the financial statements are issued, for an amount that is different than the liability that is recorded on the books. So to kind of condense it a little bit, you have a situation where you may have an accrual on the books for a legal item, and during the subsequent event period post 12/31, you find out that accrual needs to be increased or decreased. That would fall under your type 1 situation. Another example could be like a customer that owed a company money at year end, declares bankruptcy after the balance sheet date. So maybe the COVID-19 situation impact had on a company was that it put them out of business. And so you would need to consider that, obviously, and determine what the appropriate course of action would be over that accounts receivable balance. Is an adjustment needed? Probably likely. Was a portion of it needed to be written off? Does it need to be just completely written off? So that would be your type 1 examples, a couple of examples. So how should the type 1s be reported in the financial statements? Are all of the adjustments recorded, or can auditors apply materiality? So auditors can certainly apply materiality in these cases. We have to ensure we're including both qualitative and quantitative factors as we're making these adjustments and disclosures. The type of disclosures that are required for type 1 events are disclosing the nature of the event and its impact on the area that it's touching, basically. So type 2 events are different than type 1. The type 2 subsequent events provide new information about a condition that existed on the balance sheet or as of the balance sheet date, but arose subsequent to that date. And again, these are the opposite. These are referred to as oftentimes non-recognized or non-adjusting subsequent events. So these tend to be a little more common. They could be a significant debt modification after year end, commitments entered into by a company after year end, a new lease agreement that's significant in nature. Maybe there was a business combination or an asset purchase that happened after year end, but before the audit report was issued. involuntary conversion, maybe some significant changes in foreign exchange rates, a new pension plan. Just to name a few, those are some examples, but as we said, type 2 is often more common from a subsequent events perspective. So type 2 events don't require any adjustments, but they may require disclosures. And so a disclosure for type 2 sub-events is needed when that event has a significant effect on the balance sheet at the time of occurrence. Or without the disclosure, the financial statements would be misleading. So there is some judgment there, materiality, as we talked about, understanding the users of the financial statements in order to determine what the appropriate course of action for disclosure is. You also want to disclose like the nature of the event for a type 2 subsequent event and an estimate of the impact on the financial statements. If you can. If you can't, then you would basically say that an estimate cannot be made as to what the impact is on the financial statements. A question will often come up about would an entity ever have to include any financial data within their note disclosures related to a type 2 subsequent event. That can happen. An entity may include pro forma financial data in the footnotes, depending on the nature and the magnitude of the event. So it would basically you would set up the disclosures as if the event had occurred, and you could consider presenting pro forma statements, usually a balance sheet only, in order to give some kind of perspective on how would the subsequent event have impacted the numbers had we recorded it. So to sum it all up, regardless if you have a subsequent event or not, you do have to have a disclosure in the financial statements. It's usually a subsequent event disclosure towards the end of the accounting policies section, stating that management has evaluated subsequent events through the date of our audit report. So that is a requirement, whether there are or are not any to adjust or disclose, that has to be in the financials. So now we'll talk to some of the responsibilities related to subsequent events. The auditor's responsibilities, and then we'll talk about management's responsibilities. So what is the objective of the procedures that the auditor is performing over subsequent events? This is a little bit wordy, but under AUC section 560, our objective, or the auditor's objective, is to obtain sufficient appropriate audit evidence about whether events occurring between the date of the financials and the date of our report, or the auditor's report, requires adjustment or disclosure in the financials, and that it's appropriately reflected in those financial statements in accordance with the applicable financial reporting framework. Our second objective is to respond appropriately to the facts that become known after the date of the auditor's report, that they had been known to the auditor as of that date and may have caused us to revise our audit report. So simply put, we have to evaluate whether events occurring after the period under audit requires adjustment of those financials or disclosure in those financials. There are specific assertions that were intended to address as part of our audit procedures and that come about in our risk assessment process. Depending on the risk assessment, we could be looking at various assertions that are impacted by certain subsequent events. However, typically we would be addressing cutoff and valuation. And really, the question sometimes comes up, well, at what point should we be identifying subsequent events as the auditor? It's really ongoing throughout the audit, during the audit, and it has to be done through the report date. So whatever date that we put on the audit report, those subsequent event procedures have to go through that date. So in practice, there's generally and typically a variety of procedures over subsequent events that auditors perform to get comfortable that they've identified such events and that appropriate adjustments and or disclosures have been made. We first have to understand management's procedures for how they ensure subsequent events are identified. and that's usually through an inquiry or discussion. The second bullet, inquiries of management, and when appropriate, those charged with governance. We need to inquire about the current status of items in that subsequent event period. We then need to evaluate the evidence about estimates during that subsequent event period. And basically going back to our example of litigation, looking at things that have been resolved during the subsequent event period that may impact the period under audit. A few other items, we often will obtain legal letters and request that they provide a response as close to the report date as possible so that we can understand any type of events impacting the company through that date. We will do a management representation letter where management at the end of the engagement signs that. Within that representation letter, there's often a bullet or two about subsequent events that's dated through the report date. We will read minutes of stockholders or directors meetings to see if any decisions have been made post 12/31 or post balance sheet date. We'll also request or often read internal financial reports, a balance sheet as of a year-to-date balance sheet as of the next year. So in our 2026 example, maybe we get that through March 31st, 2026, and understand what's happening with the company from a balance sheet and a P&L perspective. Then we also will consider impairment of assets. It's not as common a thing to occur, but we do need to consider if the carrying value or the carrying amount of assets has become impaired for any assets subsequent to year end. So moving on to management's responsibilities, these management also has responsibilities under AUC 560. They are relatively similar to those of the auditor. Management needs to identify and evaluate the events that have occurred between the financial statement year-end date and the auditor's report date, determine if any additional evidence needs to be provided to the auditors or if any adjustments need to be made, determine if any appropriate disclosures need to be made in accordance with the applicable financial reporting framework. Management's required to notify the auditor of any subsequently discovered facts that have occurred and notify them promptly so that the appropriate assessment can be made. And then, as we discussed previously, signing a management representation letter at the end of the audit, which again represents that the subsequent events have been accounted for appropriately in this case. So in conclusion, some key takeaways. Why does it matter that we get the accounting for subsequent events right? It ensures that the audit covers not just what happened up to the date of the financial statements, which in most cases is 12/31, but there's also companies and clients of ours that have fiscal year end dates. But it ensures that the audit doesn't just cover what happened through 12/31, but it also ensures that the audit covers relevant, significant information up to the auditor's report date. And in certain circumstances, it's after the auditor's report date. It matters because it increases confidence in the financial statements because the users of those statements know that important post-reporting events are considered when we issue our audit report. And it matters because failing to comply with the standard or apply the standard correctly could lead to misleading financial statements, which could have, regulatory issues come about or damage to the credibility of those financial statements. So it's definitely something to take seriously and go over. So that largely wraps up the subsequent events portion of the webinar. I appreciate your time, and if you have any questions, don't hesitate to reach out. My info is there.
I was muted. Perfect. Thank you, Nathan, for joining us today to talk about that. I think we continue to get questions. As you mentioned, it seems like COVID wasn't that long ago. I know it's been years, but I think with just continuing business cycles, there's always something new coming out, whether it's, tax legislation that it's impacting certain accounting, or, obviously changes in different agreements that we do tend to, we're checking this on every client, and, for the clients and accountants on the call that are dealing with, it's not like everything stops on December 31st or on your year end or even, each month. So it is something that comes up. We've seen it, more and more where we're having to have disclosures around significant events after the date. So just wanting to bring everyone back up to speed on that. We do have code word number 9, which means we're getting close to the end. Code word 9 is 677, and I promised myself I wasn't going to make a 6-7 reference, but it's really hard not to when the code word has 6-7 in it. So I apologize for that, but can't pass up the opportunity when it's right there. I'm going to be the final presenter for today, and hopefully will bring some clarity to accounting for stock appreciation rights and warrants. As I mentioned earlier, I'm Jessica Boycourt. I'm a director in the Technical Accounting Advisory group, which is a part of the Audit and Assurance group at KSM. I help to provide technical guidance to KSM clients and engagement teams to help them better identify issues and understand complex accounting and auditing topics. My role primarily focuses on compliance measures such as internal quality reviews and technical training and resource development. I also run this webinar, so that's where most of you have probably seen me. I love how many chats I just got about the 6-7, so I'm glad that everybody is still hanging in there as we enter into, we're 2 hours in, we're almost to the end. So I actually didn't know that code word had 6-7 in it. So thinking on my feet to keep everything interesting today. So as I mentioned, I'm going to talk about accounting basics for stock appreciation rights and warrants, which is a topic that I wouldn't say it comes up frequently, but it started to come up more frequently in recent years as we have more, I think it's from private equity backed firms. They're trying to find other ways to compensate employees that's not just a paycheck. And one of those is using different stock options and potentially warrants as well. So our goal today is to understand US GAAP accounting for stock appreciation rights, and then be able to identify what a warrant is and apply the appropriate US GAAP accounting for warrants as well. That being said, the biggest takeaway that you can have from today is really that every agreement is different, and every one of those differences can have a significant impact on the accounting. So it is imperative to either consult with the technical guidance from FASB on where you fall within this guidance for your stock appreciation rights, or consult with an advisor to ensure the appropriate accounting. So I'm going to walk through this today, but given that I have 26 minutes to do so, it will be impossible to cover every scenario. So we're going to start with the most plain vanilla stock appreciation rights scenarios to try to form at least a baseline of clarity, and then knowing that there are hundreds of variations of what a stock appreciation right agreement could look like. So in general, stock appreciation rights are a form of compensation, typically for key members of management, but could be for any employee. You actually could have where these are issued to non-employees, which could fall in a different section of the guidance. What we're talking about today is stock appreciation rights issued to employees, which is why it falls under compensation. They are a right to receive value equal to the increase in share price from a given benchmark. Settlement can be in cash or shares, but it's only for that appreciation amount. Generally, the exercise price is given at inception or at that grant date. And then typically it's, some sort of incentive, obviously, compensation incentive for retention or performance from that key employee. Those incentives, also called vesting conditions, are treated differently based on the type of condition, so treated differently under GAAP, and there could be multiple vesting conditions in each agreement, which is why I say this presentation does not scratch the surface of what all of those multiple types of conditions various performance conditions and what they're tied to, or service conditions, or even market conditions related to the agreements. So the examples are intentionally higher level. That's why this slide is a little bit misleading. I mean, in general, there are various ways that SARs can be accounted for, but the authoritative guidance in FASB ASC 718 puts them largely in two buckets: the equity classified SARs and liability classified SARs. The key feature to where they get classified is the settlement feature, whether they're settled in stock or in cash. However, there's a bullet point of 10 other ways that a SAR could be classified as a liability, which is why I have that, or it meets other stated criteria. Today, we're focusing on the settlement feature to just get the basics, but know that awards could be liability classified if they have conditions or other features that are indexed to something other than market performance or service conditions. So even if they were settled in stock, if there are certain conditions indexed to something else, they may be liability classified. There's actually another section of the guidance, ASC 480, that's called distinguishing liabilities from equity. There are certain criteria there where it would be a liability classified SAR instead of equity. If a share award has a repurchase feature that permits the employee that's receiving it to avoid bearing any risk or rewards associated with equity ownership, then you would classify it as a liability. Basically, it's taking away that, even if it's stock settled, it's kind of taking away that ownership right, so it would end up as liability classified. And then if the option or instrument in which the underlying shares are issued are classified as liabilities, then it would be liability classified. So in general, you'll have the equity classified SARs that are settled with stock, liability classified if settled with cash, unless you meet one of the 10 exceptions. We're going to walk through the accounting for each of these in our examples. Again, I think this highlights why it's important to involve someone to know what kind of conditions you have in your agreement. So this is our first starting base. The easiest way, I think, to walk through it is to look at an illustration. And again, you'll notice it's all round numbers. It's all, they're issued exactly on the first day of the year. So all of that makes this very easy to do the example. But the question I have is this stock appreciation right going to be equity classified or liability classified? Given that I don't show that they have any other conditions or they meet any of those exceptions, we're really just going to focus in on the settlement, and that it's settled in shares at the end of the 3 years, assuming that they are vesting all at the end of 3 years and that cliff vesting. So in that scenario, because it is settled in shares and we don't have any of those other conditions in our example, this is going to be an equity classified SARs. And we'll walk through what we do then for initial measurement along the time frame of the vesting period, so during that 3 years, and then at settlement. You'll need these key facts as we go through. It'll be easier to see once you have the slides in front of you, hopefully to refer back to, but I hope this will make sense as we flow through. So the initial measurement for an equity classified SARs, it's going to be measured at fair value on the grant date. SARs are measured at fair value, typically using an options pricing model like Black-Scholes, Monte Carlo, or the Lattice model. Black-Scholes is most commonly used, but those models all consider the expected term, volatility, risk-free rates, dividends, and really any other assumptions that might be relevant for the award. Fair value is determined in accordance with ASC 718 rather than strictly under ASC 820, which is the fair value measurement standard. And the reason it's different is because of the various vesting conditions and other unique characteristics that these types of agreements could have, arrangements could have, that can impact the accounting and timing of when the expense should hit. So it's not that it would be classified any differently under the fair value measurement standard, but the way that you're calculating it could be a little bit different. You'll notice I have that there's private company exceptions to that fair value determination where you can use calculated fair value or intrinsic value. However, fair value is expected to be used if it's practicable, and really you don't see very many cases where it's not practicable, and that's always preferred. However, there are practical expedients for private companies to help apply it. But if you are unable to, you could use calculated value if company specific volatility cannot be estimated in those pricing models. And then if the terms of your award are so complex that doing fair value or calculated value like just ain't gonna work, then you can use the intrinsic value. Hopefully we're not entering into instruments that are that complex. However, you do have an option. So we're thinking about fair value then on a grant date, and the grant date is also could be called the measurement date. It's when the employer and the employee have a mutual understanding of the key terms and the employee begins to benefit from the award. A lot of times it's going to be the date of the agreement, but not necessarily, because there could be performance conditions or other items that are not yet defined. So you can't then say that there's mutual understanding. One example of this would be if there's a performance target based on a budget, but that budget is not yet approved, even if they've issued the agreement for the SARs, you wouldn't be able to say that we have a grant date yet until that budget is approved. Another thing that happens is you could have a target that can be adjusted by maybe a board or, the overall, those charged with governance, that at their discretion, they can change what that metric is. Well, then there's no agreement to what those key terms are, and you wouldn't have a measurement date yet. At measurement date, then, the SAR is recognized as compensation cost over the total requisite service period with the offset to additional paid in capital. So because we're going over the service period, you won't have an entry at the grant date. However, you'll notice that you still need to measure the fair value of this, which it was given in our example. You're not making a journal entry at this point in time, but that fair value is going to drive how you've made, how you record things over time, to over that vesting until it's exercised, which you'll see that on the next slide, which is what you do when you're subsequently measuring this equity classified SARs. So you never remeasure that fair value after the grant date. So you're going to be stuck with that $4 in our example, that was the fair value. And we're only making adjustments to that if for some reason there was a forfeiture or the SARs agreement is actually modified, then you would go back and make an adjustment there. But the total compensation cost is then going to be fixed at that grant date, not adjusted. But over time, over the 3-year vesting period, you're recognizing that cost into compensation expense and additional paid in capital for the compensation expense related to that award. At the exercise date, so the end of that 3 years, when the employee receives the shares that are equal in value to that appreciation, you're going to remove that APIC that you had related to the SARs and record your common stock that was issued plus any additional paid in capital related to that new price, that fair value price, which I think was $10 in our example. And there's no additional compensation cost recorded because you've already matched that compensation cost over the vesting period and recorded that over time. I think in summary, it's easier to see like the life of the event or the life of that SARs, what's happening. You are measuring the fair value on the grant date. If it's a 3-year vesting period, you're recognizing 1/3 of the cost each year into additional paid in capital and comp expense. And then at exercise, you're issuing those shares at the value that we had defined in our example. And any offset's going to go directly to equity and removing those SARs from equity. Grant date fair value is going to drive total compensation costs. There's no remeasurement. Expense recognized over vesting, and exercise moves the additional paid in capital from the SARs into the permanent equity accounts. Any stock price changes that happen after the grant date are not then impacting expense recognition. So that's the illustration for a equity classified SARs. You'll notice these are pretty much the exact same facts, except we've changed the settlement here to being in cash. So it wouldn't be a very interesting presentation if I walked through an equity classified SAR twice. So I did change the settlement to be in cash, which then means that we're going to have a liability classified stock appreciation right agreement here. You'll notice the difference in the accounting as we walk through, that at initial measurement, we're doing fair value on the grant date. It's not fixed. We don't need to calculate it. Okay. So we're basically doing nothing on the grant date. This was the easiest table I made in this whole presentation. Again, private companies can elect to use the fair value, intrinsic value, or calculated value methods. I've noted here you can only use calculated value for liability classified SARs if you're also doing so on the equity classified ones. So generally you're going to see this at fair value or intrinsic value. Again, at this point, you need to know what that grant date fair value estimated was just for reference. It's good information, but there's no journal entry, so you don't ever really use that $4 of estimated fair value at the grant date. It sounded easy at initial accounting, but subsequent measurement is a little trickier because you're going to remeasure the fair value annually at each reporting date for the company. Again, fair value is determined using that option pricing model, same concepts that we talked about before with the equity classified SARs, but just applying it annually now. So you'll see in the table below that at each reporting date, when you value the SARs, that's what's driving the compensation cost. So in the other example, the compensation cost was fixed at the beginning and spread over the vesting term. Here, your compensation cost is going to vary, and the expense recognized per year is going to vary based on the fair value over time. Clear as mud. But that table, I think, if you have time to let it soak in, you kind of have the same where you arrive at the same pattern or at the same amount of fair value at the end of the term, but the way the cost has been recognized each year is different. At the exercise date, this is where the company is going to pay out the cash equal to what that value is. So we'll see there was, based on our facts, there was a $20 stock price at the end, and their base price was 10 because that's what we had most recently remeasured that stock appreciation right to. And there's no additional comp expense. We're just getting rid of the liability that we had recorded for the SARs and crediting the cash for the cash we've paid out. This shows the journal entry summary over time, and you could compare that back to what the equity classified SAR looked like over time and kind of see the difference in impact for those. Liability classified SARs do create more P&L volatility because that compensation cost is remeasured each period based on the current fair value. The liability account will always represent the company's obligation to pay what that intrinsic value is, meaning the fair value at the end of the vesting period in cash. At exercise, that liability is just settled. There's no reclassification to equity, so you're not impacting equity at all. And there's no permanent additional paid in capital balance because all of those amounts had just flowed through your liability and comp expense over the term of the award. I do think this highlights again why it's important to know that each agreement is different, and sometimes as the agreements are being written, maybe what the intention is behind those from the company and issuing them is not how the accounting will look. And so it's important, even as you're drafting these agreements, to involve an advisor, especially on, if we write the agreement this way for these stock appreciation rights, when we get to the accounting, are we going to be surprised that we have to add equity, or that we have to now do a fair value calculation every year? Just based on some of the conditions of the award. Not that your accounting should drive the type of compensation arrangement or that you want to have for your members of your company that are getting these stock appreciation rights, but just ensuring that you don't put yourself in a situation where the accounting is greatly different from what your intention was when, providing this form of compensation. Next, we're going to talk about warrants, which is similar but dissimilar in some ways. And I say that because, again, there's multiple types of ways that this can be accounted for based on what is issued. So a warrant in general is a type of derivative, meaning that its value is derived from the value of an underlying asset. So depending upon what that underlying asset is, and what it's connected to, will change your accounting. And we'll see that on the next slide. But corporations or companies could issue warrants that allow you to buy a company's stock at a fixed price during a specific period of time, which is very similar to a stock option, except it's issued directly from the company. Shares can cause dilution, and it's generally a longer term investment as well. So it could be, we see these, I worked some in the ESOP space. You'll see if you have a new ESOP, there's been a trend, you could issue some warrants if you have a leveraged ESOP, or you might issue stock appreciation rights in that the ESOP stock. They're different, kind of similar function in terms of providing a benefit in the future, but have a little bit of different accounting as well, based on why you would want to use them and if there's dilution or not that you would want to see there in the value. Again, a lot of options for how to account for this. The first section, warrants issued without debt, is going to be very similar to what we just talked about with SARs. You'll notice that that is the first bullet under accounted for under ASC 718 as a share-based payment. Could be to an employee, and then you would be doing the exact accounting as liability or equity that we just did. However, they could also fall under 815 or 480, which we are not covering. That is freestanding equity-linked instruments. The other option is that warrants can be issued with debt, and then you're accounting for those warrants under ASC 470, debt with conversion and other options. Again, they can be classified as equity or a liability depending upon they're similar criteria for that cash settlement or other settlement liabilities. But for those without debt, we're going to look at like what we just did before, but the ones that are issued with debt are a little bit different accounting. We're going to assume this is our illustration facts for a warrant, and we're assuming that it's issued with debt again, because if I did one of the other options, we'd be walking through what we just walked through. But the first step here is also to still have to determine the classification of whether this warrant issued with debt is equity classified or liability classified, which is generally if the warrant is settled in cash, it's going to be liability classified. So similar framework there for thinking about whether it's liability or equity. You'll notice this is where it will be very similar in terms of the fair value measurements, but you're gonna have some debt because we're issuing it with debt. We're gonna have a debt component of discount that we're recording. But when you look at what's actually happening with that warrant liability being adjusted to fair market value, that's gonna be the same as the accounting we just went through for liability classified SARs when you're looking at just the warrant liability. So initially, when you're allocating the fair value to the debt and the warrant at the initial accounting, there it's going to depend if you have freestanding debt or if it's embedded. We don't have time. Actually, nobody has time to go through embedded derivatives today, which we could in the future. But for simplicity's sake, if it's freestanding, then we're going to record it as liability classified at fair value. If it was equity classified, no remeasurement, again, similar to what we just walked through. The fair value for these warrants at initial recognition, there's no change initially. You're recording the fair value just of that warrant over the same term of when it's going to be issued. So you'll see that this is very similar to what we did with the liability classified SARs. This is what's happening for that warrant. The changes are flowing through earnings in the gain or loss versus through compensation expense. So it's a little bit different in that regard because we're under the debt guidance, not stock comp. This is why we say to contact your advisor, because there's a lot of numbers and calculations. This is what's different between the stock appreciation rights issued as comp expense and the warrants. When they're related to debt, you're also going to have to amortize any debt discount for the difference between how you bifurcated the fair value at issuance. This math has a little bit of a rounding here, but the key point here is your debt term was 5 years. The warrants were over 3 years. So you're also going to be potentially looking at different timing between how you're amortizing a discount on the debt and revaluing your warrant liability. At exercise, you immediately, right before exercise, again, you're revaluing to fair value and you receive that cash payment. It's going to be the same as we talked about with the liability classified SARs. If it's unexercised, you do reclassify it to a gain and earnings. Overall, the key takeaways, fair value changes of that warrant liability will run through earnings each period. The kind of difference here when it's issued with debt is a debt discount is going to also impact your interest expense over time that reflects the cost of this financing. And then at exercise, both that warrant liability and cash proceeds are reclassified to equity. And there's no additional gain or loss recognized. I made it through. We'll have a little bit of time with wrap up, but key takeaways. This is hard. There's multiple options for where things get classified based on the terms of the agreement. Reach out to whoever you're working with at KSM to help you understand where the guidance ends up. Again, I'm Jessica, code word 10, getting it in right before 1:30. 365. So I'll leave that up for a second. I want to start by thanking all of you for joining us. I know that the end of the year is tough. You have plenty of options for fitting in CPE and also trying to get all of your regular work done before the holiday breaks all hit for everyone. I want to thank all of my presenters today. They did a fantastic job. I learned so much from each of them, and I hope all of you did too. We do want to give a shout out to our tax update webinar that is next week. It's next Thursday. You can go to the KSM website to make sure that you get registered for that. It's Thursday, November 20th. Same format as we followed today from 11 to 1:30. Also eligible for 2.5 CPE credits. Next year, we're going to be hosting 2 ANA webinars in 2026. The next one won't be until May 13th of 2026. We'll send out some information on that as we approach March. Don't forget to check out before you leave. If you submitted a question that was not answered or you have follow-up, please reach out to us. Thank you for joining us again today, and we hope that you have a great end of 2025, and we'll see you again. If we don't see you next week at the tax seminar, we'll see you again in 2026. Thank you.